Hi, Norman Hallett here with your next 4-minute drill for traders. I'd like to talk about something that less than half the traders I've ever talked to won't do. And because they won't do it, they're missing out on big profits fast. And that something is shorting the markets, selling a contract or a stock as a first move, and then buying it back later at a lower price to yield a profit. I don't care whether you trade stocks, futures, forex, whatever. If you take a look at any chart in any time frame, what you'll immediately discover is that markets move faster to the downside than they do to the upside, considerably faster. Now, to the trader who is willing to short the markets, this means bigger profits faster. So why is it that most traders don't even consider selling the markets first and then buying it back later at a lower price? Now, if you trade stocks, it could be that selling stocks you don't own requires a margin, and that may cut into your ability to control more shares. And that's not attractive. I almost understand that, but I believe that in all markets, including stocks, one main resistance is some kind of underlying nervousness, fear of selling something you don't own. How can you sell something if you don't own it? It doesn't really make sense. For some, including me, when I was starting to short contracts, it's not intuitive. Buying something first and then selling it later, that's intuitive. However, I think if there were a number one reason that most traders stick to the long side, it would be the exposure to a seemingly unlimited loss. You see, if you buy something at $50, the worst that can happen to you is that something goes to zero and you lose the $50 but no more. If you sell something at $50, the market could go to infinity, wiping you out in one move. Now, that would be true if you didn't use stops or you didn't employ a hedge-type counter position. But it's not true if you do employ these things. In fact, the fact is that there is equal risk on both sides of the market if you're a responsible trader. When I first started trading in 1980, I don't know if any of you were around for that, a few of you maybe, the Hunt brothers from Texas cornered the silver market, and silver went from about $3 to $50 in the matter of a couple of months. Then the government stepped in and allowed selling only and barred the Hunt brothers from the market, and the silver market proceeded to have limit down drops for 22 days in a row. Whew. Now, most down moves are not quite that dramatic, but again, if you look at any chart, you'll see that you may be able to make money in larger chunks and faster if you learn how to short the markets and not just buy them. Remember, of course, to keep your stops in and employ hedge positions when appropriate. And that will help you stay out of harm's way and build your courage to do something, well, that may not be intuitive. And that's to take advantage of the short side of the market. Now, if you've got a shorting the market story to tell, I'd like to hear it. I think everybody'd like to hear it, good or bad. Give us some detail, and let's try to expand each other's horizons. Click the comment link and let's hear from you. Okay, that's it for this edition of 4-Minute Drill for Traders. So until next week, stay disciplined, please.